If you keep the books for a business, a shop, an online store, or a growing brand, you already know how to record what came in and what went out. But there's a sister skill that far fewer people can name, even though most have already done a piece of it. It's called FP&A, Financial Planning and Analysis. And if you've ever built a budget in a spreadsheet, you've already taken a first step into it. I've spent 10 years building these systems for finance teams. So let me clear up the confusion I see all the time. Here's the difference. Accounting answers one question: what happened? It records the past, every sale, every supplier bill, every wage, accurately and by the rules. It's essential, but it looks backwards. FP&A looks forward. It takes those numbers and asks, what's going to happen next and what should we do about it? If accounting is the rearview mirror, FP&A is the windscreen and the GPS. You need both to drive, but they do very different jobs. And the whole point of FP&A is that it boils down to 3 words that you hear all through this video: plan, report, analyze. Those 3 words are a cycle that repeats. First, you plan a budget for what you expect to sell, spend, and earn. Then as each month closes, the real numbers, we call them the actuals, they come in from your accounts. You report those results to whoever's running the business. And then you analyze the gap between what you plan and what actually happened. And this gap is called the variance. And from there, you learn and you decide on what next to do. Right? Open a new store, cut a line, change suppliers, raise prices. And then the loop begins again. That's the rhythm of FP&A. It's not a report that you file away once a year. It's a steering wheel that you hold all year round. Now, when a business is small, you can run that whole loop in a spreadsheet. And honestly, it works fine. But as the business grows, the spreadsheet starts to crack. And you've probably seen the signs. There's the file called Budget Final V2 latest, Budget Final V3 latest. And nobody's sure which version is really the final version. And then there is that one monster file that one person understands and everyone else is afraid to touch. And then there are the errors. A 2024 study found that up to 94% of business spreadsheets used in decision making contains at least one critical error, and a single wrong cell has cost companies millions of dollars. On top of that, there's no record of who changed what, and the only way to handle more work is to hire more people. None of this means that you're bad at a job. A spreadsheet was just never built to do this. So let me make this real. Meet Brightline Goods, a US retail brand that started with a single store and now sells across the country, in its own shops, online, and through wholesale partners, and lately overseas too, through an arm in London. They're exactly the kind of business that outgrows a spreadsheet. Here's what it looks like to run their numbers on a platform built for the job. Ours is called Planir. The first thing that it does is that it connects to your accounting system or your ERP, whatever each part of the business runs. Instead of exporting and emailing spreadsheets around, every entity's data flows into one place automatically, and it's always up to date. The industry calls it a single source of truth. There's only one set of numbers and every figure traces back to its source. Let's start with planning. And this is where FP&A really pulls away from bookkeeping. Most people budget the simple way. They take last year's numbers, add 10%, and they're done. The trouble is that the number isn't connected to anything real. So the moment the business changes, that budget becomes fiction. A driver-based budget fixes that. Instead of just typing in a sales figure, we model what actually drives it. For Brightline Goods, that's the units sold times the average selling price. And on the cost side, we have the cost of each unit, plus the store rent, staff, and marketing. It's like a formula. You set the quantities, and when one changes, everything else recalculates itself. So the next time the CEO asks, what happens to profit if we raise prices 5% but sell a few less? Nobody needs to rebuild a spreadsheet for an hour. You nudge a couple of drivers and watch the answer appear. And because it's a three-way budget, profit, balance sheet, and the cash flow are all linked, you see the effect on the bank balance, not just profit. That matters because plenty of profitable businesses have still run out of cash. That's the difference between the budget that you guess and one that you can actually defend to a bank or an investor. Next, reporting. Every growing business has people who need the numbers. The CEO, a business partner, a bank, the board, investors. And here's the pain that everyone knows. Building the report by hand every single month, copying figures across, reformatting the charts, hoping that everything reconciles. It's hours of work and it has to look the same every time or people will lose confidence. This platform turns that into a few clicks. Clean, professional reports and live dashboards in minutes, identical format every single time. And the consistency isn't just cosmetic. Once you have made a loan or taken on investors, those reports are often contractual. Numbers that show up on time, looking right, and are part of how people decide to trust you with more. Then comes the part that earns the word analysis. Knowing you missed the budget isn't useful on its own. You need to know exactly why. Think of a variance like a smoke alarm. It tells you that something is wrong, but not where the fire is. So the platform walks you through from the alarm to the source. First, variance analysis lays out how your actuals are faring against the budget, side by side, and it flags every line that's off, saying one product line's costs are running hot. Click into that account, and the account intelligence explains it in plain English, the drivers behind the change, written up in a way that you'll put across in a board note. Then, when you want the hard proof, you can drop one level deeper into transaction intelligence, the individual transactions behind the number, where you can search, filter, and check each one. The detective work that used to eat an afternoon of digging through tabs now takes a couple of clicks. Alarm, cause, evidence. And here's something a spreadsheet makes genuinely painful, looking at the same numbers from different angles. Brightline Goods doesn't just want one bottom line. They want to see it broken down. How's the online channel doing versus physical stores and wholesale? Which product category has the best margin? Is the UK keeping pace with the US? In the platform, every transaction is tagged by product category or by sales channel, so you can slice the report any way in just a few clicks. And because the US and UK are separate entities, you can sort them easily and see the difference in performance. Watch. Here's the P&L, filter to the online channel, and the numbers redraw. Switch to a product category and they redraw again. No new spreadsheet, no rebuilding of the pivot table. It's the same single source of truth, just seen through whichever lens you need. And now the big one. The problem that made month-end a nightmare in the first place. To see how the whole group is doing, Brightline Goods has to combine its US and UK companies into a single consolidated picture. And that's much harder than just adding them up, for two reasons. The first is currency. The US business earns in dollars and the UK one earns in pounds, and it all has to be translated into a single reporting currency before any group total means anything. The second is intercompany transactions. So here's the trap. The US companies supply to the UK ones, and the UK arm buys them to sell them on. And so if you simply add the companies together, you will count that revenue twice. Once when the US side ships the goods, and once when the UK side sells them. So you have to strip them out, or you risk overstating the group sales, and that's intercompany elimination. This process can be tedious and painful, and there are many businesses out there who only see their consolidated financials once a year because of that. Planir does that for you. It translates the currencies, it does the intercompany elimination, and it gives you a single consolidated view where the numbers actually tie. For most businesses, this is exactly the time when they realize that they have outgrown the spreadsheet for good. One last thing, and notice it's the last thing I've mentioned, not the first. AI runs across the entire platform as a layer on top of everything that you have just seen. You can ask it about any number on the screen and get a simple English answer. It writes about what changed and why. It'll even build or rearrange a dashboard for you. It does the legwork, but you can keep the judgment. And that's the point. The value of AI was never AI on its own. It's the clean, connected, single set of numbers underneath it that turns a clever assistant into one that you can actually trust. So, that's FP&A. Plan, report, analyze. Steering a business with its numbers and not just recording them. It's what every growing business eventually needs. And when one business becomes many across different product lines, countries, and currencies, it's exactly what we built Planir for. If this was useful and you'd like to see it run on your real numbers, drop me a message. Let's chat. Thanks for watching.